Well, g'day there, everybody out there, right around the world, listening to this YouTube recording. This is going to be a continuation of from the analysis which I just produced for the US dollar, and again, the potential of that macro pivot point, again, at that very strong support level, whereas we could see a parabolic rise or at least some continued strength into the US dollar over the next or for the foreseeable future. What does this mean for gold and silver? This is going to be a little bit of a sort of an intermarket analysis or relationship sort of breakdown as to how this is going to be potentially priced for gold and silver, and the effect or the influence which the US dollar in terms of purchasing power has, unfortunately or fortunately, for commodities based in US dollars. Now, it's quite interesting to me that if I go back to the US dollar, let me just bring this up for us, the dollar index, pardon me. You can see obviously for all of the aforementioned reasons in the previous video as to why I am rather constructive and still hold a very positive outlook for the continued appreciation of the US dollar for the foreseeable future. Really what that means is that if the US dollar continues to strengthen off from this pivot here or off from this 99 handle, what does that mean for gold and silver? And I find this quite interesting because gold itself is at a very interesting location on the chart itself. What we have seen really since early March, since we established this short-term little swing low over here, is that we have seen again this parabolic rise back up to its sort of micro swing high. You can see right here, just shy of 120 on the ETF. We are starting to see again a little bit of a variety of bearish candlesticks. We are seeing again some exhaustion gaps. We are seeing some relatively bearish candlesticks set up over the past two trading sessions, Monday through Tuesday. And again, it is showing up at that right location, generally the vicinity where we would expect some form of an intermediate sort of turning point to occur for gold and also silver. You can best see this really by the declining, or at least the sideways moving 200-day simple moving average. You can see that we retested this for the first time since we broke down below it towards the end of February. Since then, we sort of have been, or at least ping-ponged off from that 100 simple moving average, and now we've moved back up to the 200 simple moving average. What we can do, much like the US dollar, is understand that this is some form of an inflection point. Whether we break out above it and continue back up to 123, that is a very possible and logical outcome. However, having said that, the potential for a reversal at this 200 simple moving average, based on, of course, the intermarket analysis between the US dollar and gold and silver, is sort of in many ways more favorably sort of suited for the pullback, and at least the longer term, I guess, pullback which has been happening for gold and silver, and muchly and for greatly more so the commodities for quite some time. Since 2011, we have seen again some form of a parabolic blow off top in commodities. You can see that we have sort of moved sideways. We've tried to stabilize for a number of years post the 2011 high. We did break down in 2013, and really since then it has been on a macro scale a series of lower highs and lower lows. Fast forward through to 2016, we saw a very strong year for commodities. However, since peaking out in July, we have once again started to see the consecutive series of lower highs develop. Now, at the moment, it is a little bit contentious, where it's somewhat hard at this particular point to really call this the continuation of the macro trend since 2011 to the downside, or whether or not this is some form of a reversal taking place. There was a lot of fear, a lot of panic towards the end of December 2016. The bottom was getting taken out. It looked as though we were going to revisit some of these lows back in November and December a year earlier in the year 2015. However, once again, we have seen the Trumpflation sort of trade take off to the upside, but we find ourselves once again at this swing high. Now, going back into the nitty-gritty of the analysis itself, you can see the exponential moving averages are more or less moving sideways. They can't really help us. We are in sort of a consolidation zone, which is best sort of surmised by the sort of price action taking place between the 100 and the 200. However, when we start sort of looking at these swing highs, where the US dollar is currently positioned, and of course some of these oscillators which are moving back up into overbought territory, it makes a lot of sense once again that we are going to see some weakness flow back into gold and silver. Now, again, this isn't a personal attack. This isn't to sort of scare anyone or to sort of rumble anyone's feathers, so to speak, but it is just reality. And again, you sort of have to disconnect yourself. It's not that you sort of, but you must disconnect yourself, I guess, emotionally from financial vehicles or assets which are traded on financial markets. If you don't, you are going to be set up for, again, potentially a little bit of pain when the chart itself is telling you something, but you just aren't really realizing for what it is. And at this particular point, again, a lot of people are swept up in the emotion of gold and silver, but this is the critical inflection point, more or less, where we currently find ourselves. The MACD is sort of plateauing. It is moving sideways. The RSI is starting to adjust, which is relatively interesting. And when we go out into larger fractals, again, we've just changed from the daily up into the weekly. You can begin to see how the oscillators are starting to suggest weakness. You can see the Stokes is up here overbought. It is suggesting, again, some form of a turn down. The MACD still hasn't even printed into positive territory on the weekly time frame. So again, it's showing that momentum is relatively weak, and it does have a bias to the bearish side. And if in context of this chart, and of course, some of the strength which we have seen towards 2015 to, I guess, the mid 2016 high, in context of this move, it looks as though we have sort of established right through to the current juncture some form of an intermediate dead cat bounce, which may be finishing at this particular point. If we go to the monthly charts, you can see that they are still bearishly aligned. The last time that they were bearishly aligned was really at the top in 2011, and it wasn't until we moved into oversold territory, which can linger there for quite some time, until we eventually saw what I assume to be some form of an intermediate bounce or even a macro bounce to suggest that next significant lower high, which is establishing itself for commodities across the board. So, I mean, there are a lot of warning signals. If we go back out into the daily timeframes, I mean, you can start to see some of the divergences, even on the daily time frame across these oscillators. If you go out to the weekly time frame, again, it just shows you that the lack of commitment or momentum behind this recent bounce, albeit however strong and however fast and parabolic it actually was, there is a lot of things to really be concerned about on this chart. And again, just to put this in context for you, on the weekly chart, if we zoom out, you can see that since 2011, pricing up here at 180, we have more so adjusted. I mean, quite a distance, almost down to 100. We find ourselves at 120 now, but there is still the potential for, at least on a minimum, sort of pullback, a back test of this 104. Even the 100 area once again, which would really rattle a lot of buyers or people who have been, I guess, complacently bullish in the face of potentially some form of a macro bearish trend, which we may still be finding ourselves in. You can see the CCI is trying to linger above that 100. It looks very tentative. The ADX is beginning to turn down. And if I bring up these Bollinger Bands, you see how the Bollinger Bands are separating, and you see how we're pulling away from the top Bollinger Band. When you see this with the Bollinger Bands and you start to see candlesticks at the top with the Bollinger Bands themselves extremely separated, or at least the dispersed between one another, this generally ushers in some form of a channel consolidation or an all outright type of reversal off from that top Bollinger Band. So the warning signals are here. I'm just bringing them to your attention. You also have the 50 below the 200-day simple moving average. So technically, this is still in a bearish alignment of the long-term primary trend for gold or silver, which a lot of people just are failing to really establish and sort of connect the dots at this particular point. If I bring up silver as well, I mean, you can see that we've had this red box here, and this has been sort of our tipping point or potential slowdown, turning point for silver moving forward. We've had red boxes during, say, for instance, when we saw the breakdown, say, for instance, we were shorting here at 1738, a secondary short at 1644, then the final short at 1525. We've always been talking about this sort of bounce which we've been expecting and where we expect it to run into. And for quite some time, if we were sort of forward looking at this particular point, we were saying that anywhere between 1750 and really 1670, 1680 would be a logical sort of tipping point. Well, fast forward through to late February, where we started to see the rollover. You can see how we bounced back up into my red box. We started to break down. Even with this short here, we were talking about the temporary bounce which was going to happen based off the simple fact that we were relatively oversold on the short-term fractal. But here, we sort of overshot this red box, which is a little bit surprising. However, this is what is really sort of showing up to me as a technical trader. What we've done is we've sort of overcome this. However, it's been on a gap, and this gap is very suspicious at this location. What we haven't done is that we haven't established a gap which is sort of broken above this intermediate potential swing high. In fact, we are still quite a way below this swing high over here. 1750 more or less was that swing high towards late February, early March. We sold off, we've bounced, but now we have again this gap. Now this gap over here is very similar to the type of gap which was showing up on the equity markets at the beginning of March 2017. Again, it sort of coincides in many cases with sort of an overextension and over leveraged and over sort of, I guess in terms of sentiment. As far as what we should see in equity market, or in this particular instance, a commodity move. So again, there is a lot of potential. This is what I'm really trying to say. A lot of potential that this gap, it isn't really a measuring gap, or it isn't some form of a continuation gap based on the simple fact that we are still establishing lower highs and lower lows on the intermediate and macro time frame, it does suggest that there is the potential for this to actually gap fill and then really crumble if we start to see the US dollar again really race to the upside, where there is a very high likelihood of that happening over the next couple of trading sessions, if not couple of weeks, if not months. So if you see continued strength flow into the US dollar, which is what I'm assuming is going to happen, given of course the macro support where we find ourselves in the beginning of what could be that major run up until macro higher highs, it's going to be very problematic based in the purchasing power for commodities priced in US dollars. And again, it sort of leads me to assume that we are going to get some form of a rollover. Now, the exponential moving averages are moving sideways, indicating that there isn't really much of a trend. Again, we start looking at the simple moving averages. They are bearishly aligned. We've found resistance at the 200. We've bounced off the 100, which again is very similar to that of gold. We find ourselves with the gap right at that 200 simple moving average. Volume is starting to spike, but we do have two spinning top candlesticks, again reflecting indecision or a little bit of short-term bifurcation amongst buyers and sellers. But I assume, again, that based on these oscillators that we are moving back up into overbought. This is on the daily time frame. You can see on the RSI, the MACD has only just pushed into positive territory. But even if we do overcome this 1750, we are going to have some very strong divergence on the daily time frame. Again, on the weekly time frame, have a look at this. The Stokes is back up into overbought, yet we are still producing a series of lower highs, which is, again, quite interesting given the context of where we find ourselves. This is all major warning signals across the board for gold and silver. So although I understand, of course, the reason, the fundamental reason to actually invest in gold and silver, if you find yourself trading these commodities right here, right now, based on the technical chart, it doesn't really make a lot of sense to be purchasing. It wouldn't, really the green light, so to speak, would be more so up above 1807. Now, I'm not saying that can't happen. What I am saying, however, is that this is a really dangerous position to find yourself purchasing silver and gold on the short term, or at least on the molecular level of this chart and within, of course, the financial markets right here, right now. You're going to need a little bit more confirmation in terms of the intermediate direction of the US dollar, which is going to make a lot of sense based off the inverse correlation which happens between the US dollar and commodities priced in US dollars. So I hope that makes a lot of sense to anyone. I am suggesting that there is potentially, again, or at least the probability and likelihood of a pullback roughly from this vicinity is quite high at this particular point. And because of that, I am looking for shorting opportunity. For instance, on silver, more or less right where our old short was at 1646, I am going to sort of drag it up a little bit and have it just below this red box. And the same is true for gold. Although I am keeping an eye out on the potential of a bullish bounce, for gold, that's going to have to happen above about 125. Again, we're at that critical location where technically we should start to see some form of a reaction, more or less at this point, which is going to confirm once price starts breaking below structural sort of areas on the chart, which we'll highlight in over the weekend in that pro analysis class. So I hope that makes a lot of sense for people out here. Again, a lot of, I guess, the direction in commodities is really due to, of course, what happens in the US dollar. And going back full circle to my analysis on the US dollar, it makes a lot of sense that we are going to see strength flow into the US dollar rather than weakness. And because of that, there is going to be some form, or at least there is going to be a little bit of weight moving forward for gold and silver if we start to see, again, the purchasing power of the US dollar appreciate on the intermediate and macro time scale as well. So on that note, everybody, I hope that makes a little bit of sense for you. Have an enjoyable evening. Enjoy your Wednesday and happy trading for the remainder of the week. I'll be back with you over the weekend in Pivot Point Pro for some more intermarket analysis and individual trade analysis, coupled with my discussions and my thoughts, my analysis on the US financial markets. All the best, everyone. It's James signing off on behalf of Pivot Point Trading. Goodbye.